My name is Christian Jane Kongstedt, and this is my webinar for the Q4 quarter of 2023. So it's a little bit delayed this time, but I'm going to say a bit about how I performed in the Q4 quarter, and obviously also touch a little bit on the current markets, and this is what we're going to talk about today. So an overview of what we're talking about today is some general information about me and my professional background, my performance for the last year, the way the portfolio is built up currently, and how I have diversified the portfolio, and then a bit about the current markets, and also some questions I had from copiers and followers on eToro. So first of all, my name is Christian Jane Kongstedt on eToro. I'm also known as CPH Equities, and this is the screen name you have to search for if you want to find me on eToro. You can't find me by my name. I originally trained as a journalist at the Danish School of Journalism, and I started a career in online marketing after that, where I started working with Google marketing and Facebook marketing and Amazon marketing, and this sparked my interest for some of the biggest tech companies in the world. And this is still one of my key interests today, to follow these companies and also to invest in these companies. And I have invested in these big tech companies for many, many years, and I still have them as a key component of my portfolio. I live in the north of Copenhagen with my family, and this is my wife and my two sons. And I started focusing on investing a little bit less than 10 years ago. I was investing as an amateur before that, but in 2015 I started investing more professionally, and I also started teaching trading to other people and investing to other people. And since 2015 I was using half of my time on investing, and for the last 4 years I've been doing investing full time. And also this is mainly something that I do on eToro, of course, where you can copy me. I love playing games, and I'm a 4 times Scrabble champion. I also play chess at an elite level, and I think that these games has taught me some important things that I can use in investing. So first of all, this is to have a highly analytical approach to tackling problems. It's strong pattern recognition skills, which can be used in some parts of technical analysis. And also I've been studying several times how to become an expert at something. And I know how to keep my head cool under pressure, which is also something that you need to be able to do when investing. I love a good challenge, and it doesn't matter if it's running a marathon or climbing a mountain or doing well at eToro, which is my latest challenge. I love being on eToro, and it's kind of a challenge for me to perform as well as possible, but doing it in a way where I have a good risk-adjusted returns, which means that I try to control the downside very well. I try to not have too much volatility while I'm investing. So I want good returns, but also with a good risk profile. I've been writing several books in my career, mainly books about games, different games like poker, chess, and so on. And the latest book I wrote is actually 9 years ago. I wrote it with my good friend, and we wrote about the best day traders in Denmark, and we interviewed these traders and learned quite a lot from them, and that inspired me to be doing more trading myself, more investing myself, and this is what I've been doing since that day. And I'm often interviewed by media, like national media, radio programs, podcasts, newspapers, and so on. And I mainly speak about the stock market in general, and also things like the tech stocks, AI stocks, and also sometimes about cryptocurrencies. And here you can see my performance over the years. And as you can see, I've had double digit returns for all years except for one. I had only positive years except for one, which was 2022. This year is actually going pretty well also. So the figure is not updated with the March numbers here. So I've had so far in March or this year 14% year to date in returns, and also with a pretty good risk-adjusted profile. So at this point, I have a risk score of only 3 on eToro. My annualized returns are around 20%, and this means that if these returns were to be the same in the future, you would actually double your funds in less than 4 years. And I expect to have a target that's a little bit less than 20%, but I'm going to speak a little bit more about that in the next slides. So just to sum up for the fourth quarter of last year, and also the whole of last year, my returns that year was almost 32%, while the S&P gave 24%. So I was doing almost 8 percentage points better than the S&P. My general returns during the period I've been appearing on eToro, which is almost 7 years, is 253%, while the S&P has been giving 116% in the same period. So I've been doing more than twice as good as the general stock market during this period. And also I have targets of doing almost as well in the future. So to speak a little bit about my targets, what I want to do here is to take my account from the current amount of $117,000 and into $1 million in 14 years from now. My target is to perform almost 9 percentage points better than the S&P on average, which means that some years it can be more and some years it can be less. And you can see my target that I set 2 years ago. I set the average amount that I would want to be heading for, and I'm 2 years into this challenge. So in August this year, I want to be on $119,000. So I'm only $2,000 from reaching this target that I want to reach by August this year. So one thing to be aware of is that these are average returns I'm targeting. So this means that some years it's going to be less than the 16.5% that I'm going for on average in the future. So sometimes it may be like 10%, sometimes it may be like minus 5%, and other years it can be like 30 or 40%, which has been historical. So if you go back to my historical returns, you can see that I've been having in the best year 44% in returns, but in the worst year minus 27%. And this is what you can expect from the stock market. You cannot expect all years to be positive going forward. So you will often see that 1 out of 4 to 5 years will be a negative year. So I've had around 7 years on eToro, and I've been trading 8 of those years. And what you can see is that I had 1 negative year. So in the future, you can expect to have a negative year once in a while. And this is just the nature of the stock market, that it doesn't go up in a straight line. So this is what you can expect also in the future. But overall, my target is to have a 16.5% return also in the future. And if I manage to do that, then in 14 years, then I will have taken my account to $1 million. And this is my target. So I invite you to follow me on this journey. If you're copying me or if you're just following me, then I would encourage you to follow this journey. I'm going to update continuously on how well I perform measured up against my benchmark, and we'll see how it plays out in the future. And if I'm successful in this, then in August 2038, then I can retire with $1 million. And that's something that I could do, but maybe I will at that time set up a new challenge and do something continue to be on a Toro, but I could retire at that point, that it wouldn't be such a bad retirement sum to have. So that's certainly my target. Even though it would be a little bit early for me to retire in 14 years, but we'll get back to that when the time comes. So the Q4 performance was driven very much by the Magnificent Seven, and as you can see here, they had quite good returns. All of them, maybe except from Apple, they were all beating the S&P returns of this year. And if you had an equal weighted ETF, you will see that you would have performed much worse. So my portfolio is performing much better than the equal weighted ETFs. And that's because I have this core of AI tech stocks that I think will be performing well, also well into the future. So this is still the core of my portfolio. So the portfolio as it is now, it has this core of very, very strong companies. And over the last 2 years, those are certainly the companies that have generated the additional cash flows from the companies we've seen in the S&P 500. They are very strong companies, and especially NVIDIA has been performing very well. And I believe that those people that speaks about this as a bubble may not have read the earnings results of NVIDIA and those other companies, because if you take a company like Meta, for example, they let 22% of their workforce go, but at the same time they tripled their profits during the last year. And this just tells you that the results you're seeing from these companies, they are based in realities. It's not something that's artificially inflated. Those companies are very profitable companies. They're generating huge amount of cash, and they are deploying this cash in different ways. They're buying back their own stocks in most cases, and also they're investing very much in the future, in AI, and also in buying back their own stocks. So I believe that those companies are still and will still be a very important part of the core of my portfolio, because I think they will overperform the general stock market in a 5-year horizon. And this doesn't mean that they cannot lose value. The market can easily correct, and we'll get back to that. So this is something that you need to expect, that of course there can be volatility in the future, and you can also expect these stocks to be volatile. So that's to be expected. Overall, you can see how the portfolios here, you can see the main positions in the portfolio are some of these core AI/tech stocks. You also see some financial positions having an important part of in the top 10. And of course, stocks like NVIDIA, AMD, focusing on the very strong AI trend that I think is here to stay, even though it's possible that at some later point this year, we will see a correction. If you look at the portfolio from an overall level, you will see that it's mainly it mainly consists of stocks, but also a few ETFs and some crypto. And it's there's an overweight in technology and financial services, but it's basically a broadly diversified portfolio, which I think is very important to make sure that you get good results, even if you have a correction or even if the market regime changes. So I think that's quite important. So one thing that's a little bit new and something that I've been working on over the last 6 months is to try to diversify the portfolio by doing what you could describe as 3 portfolios in one, which means that I have an AI core portfolio, a tech core portfolio, which is a very strong part of the portfolio. And this is around 20 to 30% of the portfolio, which is based in these very strong AI stocks. But I've also been building out the value portion of the portfolio. So this means that I made a lot of value picks, which are basically stocks that I believe is undervalued from a value perspective. And these are stocks that performs well in very different environment than the tech stocks. So this is meant as a diversification from the tech stocks, and something that can perform well in other market regimes than the tech stocks. And also I've been experimenting with short-term momentum picks, which means that I've been experimenting with finding explosive stocks that can perform much better than the overall market. And I'm going to describe that in a bit more detail over the next slides. So if you have been studying my portfolio in detail, you will see that I've been buying quite a few slightly smaller stocks. These are like mid-cap and small-cap stocks that I find has a good potential to explode in the in an upside direction. And what I've found interesting is that I actually managed to analyze it well and have a system that can work pretty well. So I'm much more likely to find those stocks that have explosive potential. And some of the stocks I've been trading over the last 3 to 4 months are Innodata, which surged more than 30% in 5 days. It was Iovance Biotherapeutics, which surged 61% in 6 days. No, in 5 days. And it's Sana Biotechnology, which went up 67% in 5 days. And CleanSpark, which went up even more over this period of 13 days. And then also I had a few misses, of course, and I want to bring this in also because this is something you're going to see in the account as well, that even though this system that I'm trading is very strong, it's back-tested and it works really well, you will also see some misses, and one of those misses were the stock, the Full Truck Alliance, which lost 4%, a little bit more than 4% in 5 days. So my plan with trading these stocks is that when I'm right, I stay in for a long time. I stay in for a high return if I can ride the momentum. But still, it's not like probably only for a few weeks that I stay in these stocks. So you can see that most of these stocks I actually stayed in like anywhere from between like 5 to 13 days. So it's usually only a few weeks. And then if I'm wrong, I'm also exiting the position pretty fast. And you need discipline to do that. And I think that's very important, to exit your positions and also cut your losses very fast, but then let your winners ride. Because even if I only have a 50-50% hit rate on picking good stocks, then if I can have small losers and big winners, then it's still a very tradable and strong strategy. So this is something that has been working very well for me. And basically what I'm doing, I'm not going to say too much about it because it's something that's a little bit of a secret, but I'm basically trading momentum in stocks and also looking at money inflows from big institutions and so on. So these are some of the factors that I'm considering when entering these stocks. And it has proven very successful and has also added to the overperformance this year. So this has added several percentage points of overperformance this year. So for this reason, I'm going to continue to trade those kind of stocks also in the future. But I'm only doing it with a very small percentage of my portfolio. So I can just jump back and you will see here that this is only a part of the portfolio. I'm using maybe 1% of my portfolio to trade some of those picks. And the same with the value picks. I have quite a few value picks, and those picks are also usually like 1 to 2% of the portfolio. So it's a minor part of the portfolio that I diversify in this way. And what we've been seeing so far this year is that the AI core portfolio has been performing really well, and the short-term momentum picks perform really well. And then you have something like the value picks performing reasonable, like they've been profitable this year, but not as well as the two other categories. And what I expect is that if we see a correction or a different market regime, then we could actually see the value picks performing much better, and then the other parts of the portfolio performing worse. And what you want to do when you build a portfolio is basically to make sure that the volatility is pretty low, because if your drawdowns are low, then you will not have too large losing periods, and this makes it easier for you to recover a losing period. So what I'm trying to do here is to find areas of the stock market that performs well in different market regimes. So when the AI and tech part of the portfolio does not perform well, then you will have other parts of the portfolio that could perform well. And I think this has turned out to be quite successful at the end of last year and also this year. So I expect this overperformance to continue in the future. And then I want to say a little bit about the current markets. So as you may have noticed, inflation is coming down in the sense that the rate of change compared to last year is coming down, but it proves to be maybe a little bit more sticky than some people was expecting. So right now we're having kind of a flat development over the last months. We're still seeing core inflation and also the general inflation numbers being above 3%. And obviously the American Central Bank's target is 2%, so we still have some way to go before we can say that inflation is down to the levels that we would like it to be. In any case, what we saw yesterday is that we saw Fed Chairman Jerome Powell telling basically the market and everyone that he finds it likely that there are still going to be 3 rate cuts this year. And that was a quite bullish signal for the market. So I still expect the market to be bullish in the short term until this narrative changes. And it can change with the next CPI number. So it's certainly something to keep an eye on. But for now, the sentiment is quite bullish in the markets. And that's obviously good news if you are mainly long stocks. So I expect this regime to keep on being there, at least for the following weeks. But of course, we have to keep in mind on anything that could change this narrative. And this narrative, of course, could be changed by a geopolitical event or something like that as well. So, but also the markets are at this point quite overbought. So we have to keep our mind open to the fact that we could see a correction later this year. So in general, we can say that the bullish part of the market is that inflation has come down. The economy, the US economy is very resilient, and unemployment is still very low. And as I invest in mainly US stocks, I think it's still quite bullish for the markets. The Fed has signaled that they want to cut interest rates, and that is going to be bullish as long as this narrative is the narrative that drives the market, and this can continue for a while, of course. And the latest earnings results were quite strong, so that's also quite bullish for the markets. So the bearish part and the bearish arguments in the markets is that core CPI is still quite sticky. This may mean that we will have to see interest rates that are higher for longer. And growth is also expected to slow down due to the high interest rates. So it's not unlikely that we could see a correction following the very strong bullish run that we have had during the Q4 of last year and Q1 of this year. So the market has basically risen around 25% for the S&P. So obviously, when the market is in a slightly overbought situation as this, it makes it possible that later this year we could see a correction. But I wouldn't be guessing or trying to guess exactly when this correction comes. The market can basically be bullish longer than people expect. So there's no need to try to exit the market, to try to enter later and try to time this correction, because overall I expect the correction to be pretty shallow, at least as long as we have the same narrative as we have right now that's driving the market, which means that we have interest rates coming down over time, even if it's somewhat delayed. So the most likely scenario that I see, something that I also presented at a webinar when this year started, which is that as inflation should still be coming down, but probably more slowly than we had expected. And this means that the Fed may cut rates later than we expected, and the market may be a little bit disappointed by that initially, which could lead to a correction at some point, but also later we should see rate cuts probably later this year, or at least in the beginning of next year. But if we should trust what Chairman Powell said, then I think that the most likely thing is that later this year, that's at least what he said, we should have free rate cuts, and if this holds, it's still pretty bullish for the markets. So it's likely that we see still a bullish development from here, even though it's probably going to be more slow and also with a correction along the way later this year. So to conclude this first part of the webinar, I would say that I would urge you to do the same as me. Make investing a habit. This is something that you will be happy you do later in your life. Try to put a little bit aside of your paycheck every month or every quarter or every half year. Put it into some kind of investment where you invested and exposed to the stock market, because over time the stock market has historically risen with around 8 to 9%, especially the US stock market is around 9% on average for the last 50 years. And if you can ride out the volatility, and if you are prepared to be patient and keep on being invested and keep on investing during the bad periods where the markets go down, then this can be one of the best things you can do in your life. And it's not a very difficult thing to do. You just have to put money aside every month and try to invest it in the market. And you can do that by copying me or buying stocks yourself. That's of course your decision how you want to do that, but I urge you to at least invest with regular intervals to make sure that when there's a downturn, then you actually exploit this downturn and make sure that you buy stocks also at lower prices when there is a correction. So, and now for some questions that we've had that was posted on my wall during the last update I made. And I'm going to take some of those questions now. And if you have more questions, you're always welcome to contact me on eToro. Just write a comment under one of my posts, preferably the latest post, because then I'm more likely to see it. And I'll get back to you as soon as possible with an answer. So the first question is actually focused on how to copy and how to invest with regular intervals. So this user is asking, when I have a plan to add funds to your portfolio regularly, should it always be a minimum investment amount, which is around $650, or could it be a lower amount without any issues? And the good news is that due to the changes that eToro has made to the copy trading system, you can actually now add smaller amounts, and then the portfolio and your portfolio will automatically rebalance and copy mine. So you can just add like a small amount, like $400, $300, and then the whole portfolio with which you're copying mine will just rebalance in this moment, and this can take like maybe up to 24 hours or a little bit longer if it's during the weekend. But as soon as the market opens, then the portfolio will rebalance. So the good news is you can actually now copy with a lower investment when you copy the second or third time, or if you do it with regular intervals. And this means that it's easy to copy every month, even if you just want to do it with a smaller amount. So the second the second question I got here is if I recommend to do dollar cost averaging into my portfolio every month, and this user is saying that I know that you talked about your view that this year should also be bullish, but for me, an amateur, it now seems that the market is really overvalued and the drop could be really high now. And the interesting thing is that I got this question almost 2 months ago, and the market went up since then. And my portfolio went up to maybe around 4 to 5%. So the thing is that even if you find that the market seems to be overvalued, or if it's very overbought and you try to step out of the market, you may end out losing like 4 to 5% in this case, because the market just went up further. So trying to time the correction is not the right thing to do, but dollar cost averaging, which means investing with regular intervals every month, every quarter, and so on, is, in my opinion, the right thing to do, because then you make sure that you take the timing risk out of your investment. So if you invest a lot of money and the stock market crashes, then you can actually buy more, but at a much lower level. And then even if the market crashes, then you could be happy, because then you can actually buy more at a much lower price. So I strongly urge anyone that's copying me to do that with regular intervals, because then you will find that the drawdowns are smoothened much more out, and you can actually profit from the market correcting itself if you buy during those corrections. But I would actually say to do it like at the end of each month or the beginning of each month would be the best thing to do, and not try to time the market to only buy during corrections and so on, because that is a difficult thing to time, especially if you're not following the market 24/7 more or less, or at least like 12 hours a day like I am. And then I got this question: please explain to me why you still invest in Bitcoin and cryptocurrencies. And the interesting thing is also I got this question like 2 months ago, and my answer to this question at that point was that the reason why I invest in Bitcoin is because it's simply just a very good investment. Cryptocurrencies in general is in some cases good investments, but it's also a very volatile asset. So I just looked through my history, and you can also do this to see how I invested during the last period in Bitcoin. Obviously, I had Bitcoin for many years. On eToro, I think I started investing in it for 4 years ago. And I've been in and out of Bitcoin depending on the sentiment, but I've been having Bitcoin for the last years, and some of those positions were bought in August 2022, and they are now 171% up. But then I added to my positions this year because I found the sentiment to be very positive. So I added quite a few positions in late June and the start of July last year, and I added further to my positions in November because I found the sentiment to be very positive. So basically, I'm trading this asset, and I've exited some of those positions. So what I'm trying to do here is basically to buy when the market is lower and sell when it's higher. And I've been doing this also during the last bubble that Bitcoin was in, and obviously the market has been moving up. So this screenshot is a few days old, so the market is now going up a bit further, and I'm still invested around 2.3% in crypto in general, which is Ether and Bitcoin at this point. But earlier this year, I was invested 5% in Bitcoin because I saw that the sentiment was very positive. So I wanted to make sure I was exposed to this potential bull run, and that turned out to be a very good trade. and I earned more than 100% on many of these trades that I closed during the latest period here. So basically, I try to trade this as if it is a bubble. So I try to buy when the sentiment is getting more positive. So I see the market going up, and then when we're close to or above the latest all-time high, I try to trim my positions a bit. I still want to be in Bitcoin because I think it can potentially go higher. But I also try to trim my positions because at this point it's getting more slightly more risky to stay in the asset because you will see a lot of selling when we're close to the all-time high. But right now we're moving higher, and the price today I think is around $67,000. So let's see what happens. And this is actually connected to my answer to the next question, which is what are my predictions for Bitcoin and altcoins in the next year or two? And I think in general I'm slightly bullish on Bitcoin. I still see the ETFs that we got earlier this year as a positive thing for Bitcoin, because this means that you will now see institutions that weren't able to buy Bitcoin being able to buy these ETFs. And at this point, we're actually seeing that the volume in these ETFs is 5 times the volume of daily productions of Bitcoin. So we're seeing 5 times more volume in these Bitcoin ETFs compared to the Bitcoins that are produced every day. And this is still quite bullish for the market. And that doesn't mean that it's 100% certain that the market will go up from here. This just means that there's a positive undercurrent in the market. And what is working against this is that when we get closer to these all-time high and when we exceed the previous all-time high, then we usually see a lot of selling from large traders, large holders in the Bitcoin space. So in general, there are opposing forces here, but I'm cautiously bullish Bitcoin. I've trimmed my positions a bit, and I will follow it very closely and find out how to trade this in the future. So I don't want to give some very certain prediction about where we could go, but I would just say that it's not unlikely that Bitcoin could go to $95,000 even this year. So it's certainly interesting to have some part of your portfolio exposed to this asset class, in my opinion. So if you copy me, you also have this exposure, obviously. And then this is the last question, and it's related to if there will be a market correction in the coming month, and what is my position on this. And obviously, the markets have been very bullish lately, and we haven't even seen a correction of 2% this year so far, and we are almost 3 months in 2024. So this is a quite bullish sign that we didn't have a correction so far. This means that every time the market tries to correct, you have a lot of people buying the dip. So we have people stepping in and buying Nvidia and quite a few other stocks. What we're seeing lately is that the rally is a bit more slow. And it's not unlikely that later this year we will have a correction, for the simple reason that during a normal year we tend to have corrections. So I've brought a few stats here to tell you about what you can expect from a normal year, and this also means what you can expect from this year. So in a normal year, there's a 95% chance of a 5% or worse correction. So I think that's also very possible that this will happen this year. I don't try to time this correction because I still expect the market to be bullish after this correction. So there's no reason to try to get in and out of this market, because basically I expect these corrections to be pretty shallow and within the 10% range, at least based on the narrative we have in the market now. Obviously, if facts facts change, I can change my mind. So I'll keep you updated on this. But at this point, it seems like that the markets are bullish, and I'm of course going to be following that very closely. So 63% of all years we see a correction of 10% or worse. So that's also possible that it could happen this year. We have to keep our mind open to this possibility that we could have a correction that which could be 10% or worse. And then 1 out of 4 years we actually have a correction which is 20% or worse, and that is what we have in 2022. So we had this 2 years ago, and every 4 years you can expect this to happen. So it's more unlikely to happen this year, but it's not impossible. So in 1 out of 4 years we can expect this. And then a correction of 30% will happen in 1 out of 10 years, if history is any guide. And a correction of 40% will happen in 1 out of 20 years. And the last time we saw this was during the financial crisis, which is 16 years ago, almost 16 years ago. And we can expect this to happen like once in every 20 years. So it does happen, but it's unlikely to happen this year. So these are the percentages to keep in mind to find out how likely is it to have a correction in a normal year. And I basically would say that this is turning out to be probably a bullish year. We have an election, which is usually in the US, which is usually quite bullish for the stock market, but still it's not unlikely that we will see some kind of correction. And you could say that these percentages are probably more or less the percentages that you could use for this year as well. So expect a correction later this year, but don't try to time it, because you will end up being on the sidelines while the market moves up further. So it's much better to just stay in the market and rather try to spend time in market, be invested in the market, rather than trying to time the market. That's the general advice. That's the most easy way to trade and invest. And for this reason, this is what I would recommend you to do.